Is the strike against the big three automakers coming to an end? Let's take a look into that and GDP, inflation numbers, and the other important financial data of the week. Before we begin, remember to like this video and subscribe for more economic updates. I am Devlyn Steele, Director of Education at Augusta Precious Metals. The economy has seen significant movements this week. First, let's get up to speed on the recent events surrounding the auto workers' strike. On September 15th, the United Auto Workers went on strike against all of Detroit's big three automakers simultaneously for the first time in history. But as of Wednesday night, the walkout against Ford seemed to be over, with the automaker and the UAW reaching a tentative deal. The agreement includes a 25% wage increase for permanent workers, higher starting wages, and a 150% raise for temporary workers. The deal must be ratified by the rank and file through 2 rounds of voting. Nevertheless, UAW members returned to work on Thursday in a strategic move designed to keep pressure on General Motors and Stellantis, the parent company of Chrysler. UAW Vice President Chuck Browning put it this way: "We're going back to work at Ford to keep the pressure on Stellantis and GM. The last thing they want is for Ford to get back to full capacity while they mess around and lag behind." In other news this week, despite higher interest rates and continued inflation pressures, it seems the U.S. consumer won't be deterred. Powered largely by consumers' continued spending enthusiasm, annualized GDP growth in the third quarter rose a stunning rate of 4.9%, more than double the pace set in the previous quarter. A closer look at the data reveals that consumer spending jumped 4% in the third quarter, after raising just 0.8% in the second quarter. The sharp increase in consumer spending accounted for 2.7 percentage points of the overall increase in GDP growth. Despite the unexpectedly strong GDP growth number, it's believed the figure won't be a consideration of Fed officials when they meet next week to decide what's next for monetary policy. Observers say the continued surge in Treasury yields, along with the current stock market sell-off, are making it unnecessary for policymakers to do any additional tightening right now. On that note, the CME Group's FedWatch tool currently indicates a near 99% probability that the Federal Open Market Committee will leave rates unchanged. Finally, we were treated to more inflation numbers this week with the release of the Personal Consumption Expenditures Price Index for September. Headline PCE rose 0.4% on a monthly basis and 3.4% year over year. Both of those numbers are unchanged from August. Year over year core PCE, coming in at 3.7%, was a slight drop from August's 3.8% pace. According to analysts, continued deceleration in the annual core PCE rate is an additional confirmation the Fed will leave rates unchanged at its policy meeting next week. As we wrap up, remember, the road ahead is paved with uncertainty. Stay tuned for more updates. This is Devlyn Steele for Augusta Precious Metals, signing out.